Okay, I want to know what you thought at 2:30 and then what you thought at 3:30 after the press conference.
So at 2:30, I did think it was a very hawkish statement as well as set of projections. The statement barely changed, so there was still a mention of ongoing increases in interest rates. And the forecasts were also quite hawkish, showing 5.1% for the terminal rate, with 17 out of 19 members believing that rates would be over 5% next year. No rate cuts penciled in, and rates above neutral through 2025. Actually, at 3:30, I also thought that it was a very hawkish meeting. I think what Powell emphasized during the press conference was still ambiguity about the pace of inflation coming down, and ultimately what the terminal rate is, emphasizing that it could move higher still. What was surprising was the market reaction to all of this. Directionally, it understood the message, right? Yields up, dollar up, stocks down, led by defensives, but the magnitude was very, very mild. And I think it shows that we're moving to a phase where the market is starting to question the Fed, this time for being too hawkish, not too dovish.
So how does this change your outlook at this point in the ballgame in terms of equities and everything else?
So I think for the discussion around cyclically, should we be taking more risk or not? I think the CPI report was the most important on Tuesday, because for the first time in over a year, we had the second consecutive month of below 0.3% increase in core CPI. So it is finally giving us more conviction that we're getting a disinflationary force coming from goods, coming from energy, but also starting to come from core services ex shelter. So at this point, we think we're at peak inflation. We don't think we're quite there yet on peak pessimism about the economy. So that still suggests an underweight to equities versus bonds, but a modest one, not as big a one as before the last two sets of inflation prints. For the Fed meeting, though, it still suggests to us that some of the volatility in the bond market rolls over to the beginning of next year, to January, to February, while you get this tug of war between who's right, but that we're very much close to getting peak yields, and we'll be buying any kind of increase in yields.
Who do you think is right? You just asked that question. That's a little bit of the what was it? Is it a sailboat or a regular boat, Becky? And the and the lighthouse.
And the lighthouse.
Yeah. So who is right here?
I think ultimately the market pricing for the terminal rate is right, which sees the terminal rate below 5%. And that is because we're starting to see these disinflationary forces take hold. Also because we see the economy slow down more than meets the eye, something that we expect to pick up speed next year. But we don't think the market is right in terms of this expectation for the economy to continue growing at this pace. So we don't think earnings estimates are accurate. For example, looking at $230 for next year, that doesn't jive with a soggy economy, much less a recession. And we don't think credit spreads are accurate either at 450 basis points for high yields, nowhere near pricing in a turn in the credit cycle. So it depends where you look.